Good morning. I'm Ryan Leopard. Welcome to Our Neutral Voices Presents a Financial Pillar. Joining me on the set today are my friends from DR Financial, Chris Hanna,
Good morning.
Mark Ellington,
Good morning.
and from Our Neutral Voices, James Scott.
What's going on, my guy?
I'm feeling great today. Can't
Amen.
wait to dive into today's topic. Nothing more excited than talking about some life insurance, right?
Oh, yeah.
Yeah. So today's topic, life insurance and understanding its importance in our lives. So I did some research, just kind of find out what percentage of the American population actually has life insurance. And this one got me because it looks like 50% of American individuals have life insurance. And that number has actually been decreasing, they said, by 13% over the last decade. So when I think about life insurance, it amazes me all the time because we insure our homes, right? We insure our cars. If we rent, we insure our apartments. Some of us, we insure our pets. But only 50% of us see the value in insuring the greatest asset that we have, which is ourselves, right? So it kind of makes me wonder, what the thought process behind it. I know for me personally, life insurance was not really something I looked into or was concerned about until I started having a family, right? And kids and what happens to them when you take, myself out of the equation if something were to happen. So today I want to talk about, like I said, life insurance and understand the importance and how that can fit into our financial freedom. So Chris and Mark are residential life insurance experts. Will kind of help us out with some questions that we have. But tell us why life insurance is so important to our financial lives.
Well, I think, it's part of the pillar. We're talking about pillars with a financial pillar here. I think one of the pillars, I think, of anybody's finances. I mean, obviously, having a checking and savings account and having money in there, having a job is a part of that. But I think life insurance is one of those things as you get older and you have a family and start creating assets is a key part. Like you just said, we insure a lot of other things in life, and without that life insurance, we can't provide for others if we're no longer here.
Yeah, none of that other stuff exists without us,
Right.
right? If we go
We're
away and take
the
ourselves out of the
asset.
equation, the other stuff doesn't exist there. So, Mark, anything to add?
Well, I think if you see the other side, the tragedy when somebody doesn't have it.
Mm-hmm.
I mean, if you don't have it, then you're saying somebody else is going to take care of my family.
Mm-hmm.
And usually it's other family that then has to take care of your family because you didn't.
And taking on that burden,
Yes.
right? That financial burden that they weren't ready for because you didn't plan, for that day.
And you're talking to people and you're saying, well, you're not insuring your income for your family. Who's going to take care of that?
Mm-hmm.
I mean, you really got to look in the mirror and say, okay, well, then if James is my brother and I don't have life insurance, then the family has to step up.
Mhm.
And many times that's a tragedy for the family.
Yeah. So I went in for a job interview many, many years ago with a life insurance company, not really understanding, life insurance fully. And within that interview, they, the individual that was trying to sell me on the job tried to sell me on the fact that, like, the best part of my job is when somebody passes away, I get to deliver that check, right? They're there, the family's in mourning. They don't know what's going to happen. They just lost the financial breadwinner. I'm there to financially support them with this check because they planned properly. Now, in my opinion, it was not the greatest sales tactic to encourage me to get a job. That's the best part of your job,
Sounds good.
right?
Yeah.
I obviously did not take that job, but I understood that later on, what impact that life insurance agent can make on, that situation because they were there to sell. Nobody wants to talk about life insurance.
No.
Nobody wants to talk about dying, but it's a necessary conversation to have because we may not get in a car crash. We may not have our house ever burned down, but we are all going to die eventually someday. So why not talk about it and why not plan for it? So yeah, that's what I had was, why life insurance is so important to our financial lives is to protect us from that catastrophic event. A lot of people, there may only be one income in the family, right? You think to that family that there's one of them is the breadwinner working at, let's say GM here, makes a good income, good living. Other one's staying at home with the kids. What happens when that person passes away, right? That's going to make a catastrophic life-changing event for their family. That could be detrimental for generations to come. So I think life insurance is greatly needed in our financial lives. And once again, it wasn't something I understood or was important to me till I started having kids, and understanding what would happen if I was not there. So one of the things I didn't understand until recently either is, the difference between obtaining life insurance through like a private life insurance provider or through your employer, right? I work for one of the largest corporations here in the country. I always had life insurance through them. It was very, very cheap. However, when I left that job, I kind of quickly realized, oh wait, all that life insurance I've been paying into is gone, right? Now I got to start over. So, could you gentlemen elaborate on that? Getting or purchasing life insurance through a private party rather than your employer.
Yeah, I think you always look at what options are available. So, I mean, I think definitely if you have an employer that has life insurance available, like I said, it's usually the most inexpensive. So I would go ahead and get that. But at the same token, you need to look at, like you mentioned, if you're no longer employed there, you need to check whether you have that insurance or not. And if not, then you might as well go ahead and get a backup term policy or a universal or a whole life policy as well. I don't think any family would ever say that they got too much insurance.
Good point.
Yeah.
I've read some articles and things like that, and sometimes you can have not enough, but nobody's gonna say I had too much. And again, it's all about that pricing point too, to an extent. So if you can get that less expensive insurance for there, there's always different options too. I know sometimes we deal with people that have health issues or for some reason are, you could say, uninsurable. But there's a lot of times, like at your credit unions, or if you have credit cards or different other memberships or programs that you can be involved with, sometimes they make insurance available without having to do underwriting. But the main issue there is that usually that's a lot more expensive cost, and that's why you might go to a private insurance agent to get life insurance if your health is a lot better, because it will be less expensive than just getting that policy that comes along with the with the credit card or some other membership.
So you mentioned something just there, uninsurability, right? So the difference of, and I unfortunately just found this out with a friend I had pass away this past fall, where, I don't know what his life insurance situation was like beforehand, but I know what it was like at the end. And he used to work for a large corporation as well, and then went the independent route, where I believe he probably had life insurance while he worked for there. When he left, it stopped. And once he left there, he found out that he had a form of cancer, right? Well, once you get that diagnosis, you become uninsurable, right? To where had he maybe purchased personal life insurance rather than relying on it through his employer, as long as he pays on that insurance, correct me, gentlemen, if I'm wrong, as long as if he has that policy, as long as he pays on it, even if he's diagnosed with a terminal illness, he's still covered, right? Because he was insured prior to that diagnosis. Is that accurate?
Correct. Yes.
Right.
And in today's society, I hardly know anybody that works at the same place for 20, 30, 40 years. A few of us do. I know I have the last 20. But like you said, if you only have your insurance through work and you can't keep it when you're after you leave that place of employment, then having that other policy would be very helpful. And I would, in my mind, I'm thinking, when do I start something like that? And for me, it's anybody in between their 20s and 30s is where I would definitely start. Or at the moment, you're going to start having children. Sometimes we know when we are, and sometimes we, it's unexpected when a spouse gets pregnant. And once that happens, I think that's when you go get that insurance, because a lot of times you can get a term policy for up to 30 years, maybe more sometimes, but usually 30 is about the max. And hopefully 30 years will be enough to get.
So if you start at 20, you get a 30-year policy that takes you to 50, right?
Yep.
That you're insured through that period of time in your life,
With the same price.
yeah, for most people is through that time period of when you have kids, you have those responsibilities to take care of. Insurance is very, beneficial even after that, but for 30 years during that part of your life is great. Mark, anything to add to that?
Well, I would agree with Chris, but I think you also have to look at, why do you need it? You're replacing income. What are you doing? You're replacing income. And so whatever point in time you're in a situation where you need that income to continue on. You got a wife, you got kids. That's what I'm looking at. What do I need to replace my income so my wife and kids can continue on? And I think it's a lot about legacy. I want to make sure, I always want to make sure my family was well taken care of. Because you look at the times you look around, somebody's passed away, and there they are with nothing. What's that say about the person that died? If I died and I left my family with nothing when I could have provided.
Yep. That was the word that was in my mind,
Yeah.
was legacy, right? That
Yeah.
you're leaving a legacy for your kids.
Well,
Yeah,
again, you mentioned earlier, we are the asset in this picture. Earlier, we're putting insurance on our home, which is an asset. We're putting insurance on our car, which we'll say is an asset. They depreciate. But
So-
what we don't do is we insure the most important asset, which is us, that is creating that income.
Live TV, folks.
Yes.
Sorry.
Somebody's calling in for life
That
right
was,
now.
That was Mr. Mark Ellington.
Yes.
He was
Yes.
getting a call for life insurance.
Yes,
Right
away.
now.
Somebody heard you talking.
Yeah. It's a client.
So yeah, we're the most important asset.
Right.
And to not insure ourselves, to me, is even if you're single, like, I don't think I need it. Well, you don't know sometimes when you're gonna find that special someone and get married. And if you wait till you're 45 or 50 when that happens or something like that, now that cost of insurance is a whole lot more. And plus, you may have health conditions by then.
Absolutely. That was, I believe, the situation with my friend, right? Because he had a kid later in life. And while I think his diagnosis came after, his son's birth, his son's still very, very young with that. But also the cost of that. If we get insurance earlier in our lives, the cheaper it is.
Correct.
Right? So if we wait till we're 40 and 50, right, we're closer to that end there, the insurance companies are going to mark that premium up. Right, it's going to cost more.
So is there a certain number when you're talking about the price differential from 20-year-old getting life insurance versus a 40, 50-year-old? Is it 30% more? So if you're paying $30, $40 a month here, you might be paying $70, $80 to $100 later down the road.
Yeah, it's kind of hard to quantify that a
Yeah.
little bit, but yes, let's say a general answer, yes, it's got to be a lot more expensive. It can be.
I don't know if
50%
there's
more,
a set
yeah.
percentage because within insurance companies, you can take everything into account, right, when determining what your cost is going to be for that. But absolutely, age is a huge one. So if you get that 30-year term in policy at 20, right, you're going to pay that amount for the entire time that you have it, but it's based upon your age at 20. If you wait till you're 30 or 40 to get that 30-year policy, well, now you're closer to the end. They're going to mark that up, and that's the amount that you're going to pay.
Yeah, and that cost doesn't really change much. I think in between about that 20 and 30.
Right.
And
It's not
once
a
you get past
huge
30, it
difference,
starts
but it is a
going up.
difference,
So
yeah.
that's why I tell you, like, get it before you're 30. If even if you don't have kids at that point, maybe get it so you have something and not wait till, again, a health condition arises. Now you can't get it, or you're going to cost you a whole lot more money.
And if you think about it in this term, I mean, it may only be 10, 20 bucks, something like that, but every month for 30 years, that money's going to add up. On something that most people don't see value in anyways, right? It's just money going out the door because you may not die within that 30-year period. So they think you don't get it back. But it basically insures your life, just the same thing as you may never get in a car wreck, but it insures it in case you have it while you have that
Yeah, I
car.
think one time they said about 2% of how many term policies actually ever pay out with somebody dying. It's only about 2%. So that, but again, for most families, that's an important part. Like you said, what's the percentage chance of somebody
But that's-
getting a house fire? Probably a lot smaller than that.
That's 2% of the people that have life
That's right,
insurance,
right,
right?
right,
Because there's
right.
plenty of people that do pass away unexpectedly within that time period that just may not have been covered with it, and then now their family's dealing with that. So, what is the difference between? We talked about term life. There's the universal whole, universal life. What's the correct term? Or whole life policy? Like, talk about some of the different policies. What that means.
So basically, you have three: you have term, whole life, and universal life. And term insurance, as we've been discussing, is basically going to have a fixed cost for 10, 20, 30 years, whatever the insurance company provides and what you want. Your price won't go up, won't go down. You'll pay that fixed cost for a fixed death benefit. The cheapest way in making have insurance, highly recommended, at least. Start there. Then you get into what they call whole life, where it's more of a permanent insurance. If you think, hey, I might want to have this insurance policy all the way till 80, 90, or until when I pass away, and 100, right? Then you got to have
Why'd you
something.
look at me?
Yeah, there we go. Somebody like Mark, that's why you want the whole life insurance policy or a universal life, because that can go all the way till your old age. Term's got to cut off probably 30 years after you have it. Now, good news on a term policy, a lot of them, if you get the right ones, you can convert it to a whole life policy. So you can make your term into a permanent, but it's still going to be pretty pricey. But, if you know there's a health condition and you're like, hey, it's still worth it, you might want to keep it. Whole life is where you have fixed costs. You're paying the same premium every period, month, year, whatever. And the cost of insurance in that policy is the same whether you're 20 or whether you're 80. So, it's like a flat line of cost. So in the beginning, in your young age, you're way overpaying for insurance. And at your older age, you're way underpaying for insurance. But because you've been paying it for, 20, 30, 40, 50 years, actuarially they can figure out that cost to, be even
So
across there.
understanding that at some point in time we're all going to pass away, I have to imagine a whole life policy is going to be more expensive than a term policy, right? Because the insurance
Correct.
company's betting on a term that hey, you don't pass away and you just paid us for all this
Right.
time period. On a whole, they know as long as you pay them, they're going to have to pay out eventually. So they're going to make up for that in the cost, right?
Right. And the good news at least on a whole life policy, generally there is some cash value in there. And what that means is that there is an asset of cash sitting there that sometimes you can borrow from if you need to. And you can use that money in your life still. And that makes your policy worth something outside of just the death benefit. Because later on, let's say, you get to 70 and you're like, or 80 and you're like, you know what, I don't need life insurance. I've accumulated enough assets or whatever reason I don't want life insurance anymore. You can actually just cash out your policy and whatever it's worth, they will give to you. So then you got to go, okay, but what if I want to accumulate more than what that whole life policy does? That's why they came out with universal life, which we like a lot for especially people that want to save money for the future. Because in a universal life policy, the cost is much lower in your younger age and then ramps up in your older age. But if you're someone who is working that has extra money to put into an investment or an asset, you can do what they call overfund it. You can put more money in the policy than what you need, and then they index that to the stock market in whatever fashion. And you can create that as an investment inside your life insurance policy. And as you get older and the cost goes up, well, you hopefully put more money in there. It covers that difference on the older age. What's really nice about that, you can borrow from that policy tax-free. So some people put money in there to buy a car later. So it's a great way to actually have a savings plan. So if you're thinking, hey, I want to have a savings plan, but I want to have life insurance at the same time, and I want to create my own bank that I can borrow from later, that's where you kind of take levels of what kind of insurance works best for me, which is why you should talk to an insurance agent to pick what works best for you.
So when we had one of our previous episodes, we were talking about a rich mindset versus a poor mindset. One of the things I found in banking when you're dealing with somebody of an affluent status is they actually view, I believe it's whole life policy as an investment vehicle.
Whole
as
life
well.
or
Can you
universal.
speak to that?
Whole life or universal.
Universal, yeah.
Because of that cash value.
Because that cash value, right? So you're just not putting money in there that you may not get back. As you're putting it in there, it's actually building up, right? You're earning money on that money because I believe they're paying a rate. Is that accurate?
Yeah, most whole life policies are just going to give you a fixed interest rate. So, if you're really looking for a higher rate of return, that's where the universal comes into, because they index the stock market. So you're going to get a much higher rate of return. And obviously, I mean, right now with our great inflation, these rates have come up a little bit, which has been helpful. But if you look back the past 15 or 20 years, when our interest rates were real low, it was great for you guys when we were borrowing money from the bank to buy houses. We all loved it, right? But if you went over and looked on the whole life policies, those interest rates were pretty tough. They were pretty low. It still survived, but that's where in a universal life you probably would have made a lot more money on that asset because you're indexing the stock market, and the stock market outperform interest rates continuously over long term.
Yeah. So
And
James, I'm sorry.
Yeah. So from a consumer thought process, so if let's go back to legacy, like leaving money to my family after I leave here. And when it comes to the insurance aspect of it, so if I wanted to get an insurance policy to insure, if I could afford it, like what it would cost to put in to make sure if I want to leave my family $500,000 or $600,000 or $100,000 just to kind of change, am I able to dictate that factor, like to be intentional about what that insurance policy would generate to leave to my family? Is that possible?
Money? Yeah.
Yeah,
Yeah.
you
That's
dictate that. And first off, you're deciding what is the income. Normally, we're looking at what's the income you want to replace. And so, what's it take to replace your income that your wife and kids? So that's where you're setting, how much you're leaving behind.
James, that's actually leading me into my next question, which was how do we determine the proper coverage? right? So what do you look at with your clients when you're trying to figure out what that coverage amount is that you need and what they want?
Well, first off, you're saying what is their purpose for the life insurance? Sometimes it's almost an investment vehicle. We get business people that are saying, "Hey, I've got my IRA filled, simple. I've done all this. What else is there?" And we start talking the overfunding, where they can borrow out. The flexibility of that is phenomenal. If he needs it for business, college, whatever, he can pull that out. But most of the time, you're saying, okay, what's it take to replace my income? Or I want to make sure if something happens to me, how does my family continue on at the income we're at? And so that's what you're determining. How much is it going to take to generate that income?
So you're sitting down, kind of looking at what their bills are, what their goals are, where they're at,
What's it going to take for the
age-wise,
house
things like
payment
that.
to replace your income for your wife and kids to be able to go? And maybe, if you can, you're wanting to make sure there's enough there for the kids for college if you're not around. So
So for me personally, that's what I did, was kind of looked at, what is my goal? What do I want? If I'm not here, for me, that looked like I have young kids right now. That's going to be very hard on them. My wife works a full-time job as well. I don't want them now. She's struggling to pick them up from daycare. They're not with their mom all that much because she's at work, that type of stuff. So I set an amount to where, hey, that would take care of her to be able to take care of the bills and everything else for probably a 10-year period, getting into their teen years, right? Because I want her, if she needed to be able to quit that job, to be there for them emotionally, right? And be able to get them to their, sporting events and all the things that they want to do, but not have to struggle and worry about money. So that's what that looked like for me. Everybody probably has different needs and wants and what their goals are for that money, but that's what I would look at when determining that. And when we go back to talking about what, purchasing a personal life insurance policy rather than your employer, a lot of times your employer is also only going to give you so much, right? You can only purchase so much from there. So as Chris mentioned, you can't have too much. You can have too little, but you can't have too much. So there's no harm in, hey, take advantage, because typically your employer is going to provide it at a cheaper cost, right? Because it's a group plan. Take advantage of what you can there, and then talk with your insurance provider, whether it be property, casualty, whoever, allow them to do life insurance, or seek out somebody like DR Financial and Chris and Mark to sit down and have that conversation and purchase what you don't get from your employer.
Yeah, we have a lot of clients that have more than one insurance policy, even because sometimes you may look at it like, hey, I want, $1 million of life insurance. I'm in my early 20s, got young kids, right? I want $1 million, but I also want to have that investment part of it down the road. So what you may do is say, okay, why don't you get a $750,000 term policy that'll cover for 30 years. And then I'm also going to do an overfunding universal life insurance policy. And I'm going to put $5,000 away in per year if I have it available. So what happens is when you get to that 30 years and your term insurance is up, you still have the universal life policy that now can continue on for the rest of your life. And the way we try to build them is that maybe you keep putting premium in until you're 62, around the time you can maybe get Social Security. I have to defer to the other gentleman here on the panel here today about when they can get Social
I think there's
Security.
only one gentleman here that qualifies for that right now.
But at 62, then maybe you stop putting premium in and you start taking the money out. Because that's the thing about universal life, you can actually take the money out and now live on it for the rest of your life, or use it for college or other things like that. And that's why we like the universal life, again, because of that flexibility of creating another investment asset.
I think one of the most important things that I'm hearing as a consumer is that when we say life insurance, a lot of times we think death, and that's our focus point. But in reality, man, it's not just death, it's also about life. So I think the mindset needs to understand that, man, the importance is not just to protect the death aspect of it, but it's also to, like, as you live in older age, it could change the spectrum of your financial situation. So it gives you another infusion of potential income that you could tap into at any time.
Right. And it is tough to come up with that number sometimes. I mean, you have to look at different factors, though. What kind of income do you want if something happened to you? Are there any debts that I want to pay when I'm passed away? And also, what is my budget? Right. So you have all those, and that's why working professional can really help, because you got to look at where's the right fit in that, and what's the best products I can use on that life insurance side, because there's only so much in your budget that you want to put toward your life insurance or toward an investment, and that will help you determine what kind of death benefit, because one rule of thumb is you could say, okay, if I'm on $1 million policy, if I could earn 5% on that a year, or my spouse could after I pass away, then that's $50,000 a year. Will that help my family? That's just a real simple way to do it. Will that help my family? Because then if I could earn 5% off that, then my wife can kind of keep that $1 million going and just take the rate of return off of that to help the family survive each year. So you can start seeing it. That's where you start playing with the numbers a little bit. This is a real simple way. That's where you can say, okay, is that enough or not? Do I need to go higher? Do I need to go lower? Obviously, you can spend down that $1 million, but maybe your spouse doesn't want to.
Yep.
So there's all different ways you can calculate this.
Like when I was mentioning my situation, my thought process behind it was that I wanted enough to pay off the largest asset we have outside of myself, which is the house. Right? What could be worse than losing your father or one of the breadwinners in the family? Your kids have to now be uprooted because she can't afford the house by herself. They're moving away probably from the school district, moving away from their friends. Everything changes. So I wanted enough there that she could pay off the house. She doesn't have that burden anymore. So if she is working, she can afford everything else herself. If she's not, there's still money left over even after that she could maybe not work for the next 3, 4, 5 years, however long that might be, but still live the same life, right? Until those kids get older and it's a little bit further away from that grieving period, right? And now maybe she goes back to work. But that's my thought process when I went into it. But going into, Mark, do you have something real quick?
Well, yeah, I was thinking James is talking about life. I mean, think about that funeral. You're grieving the loss of a loved one or your husband, but you're also, if there's not enough money, it is about life. What are the living going to do with you're gone? That grieving at the funeral's a lot easier if you're not worried about, wow, next week I can't make my house payment.
So being in my shoes in the banking world, I saw that all too often because, knock on wood, until this past fall, I have not really lost anyone close to me. My grandparents passed away when I was very, very young. So I haven't had that experience, but I have sat across from people in that same situation many, many times. And what's worse than losing somebody is losing somebody and now you're in a financially difficult situation because those bills don't stop while you grieve. Right.
Exactly.
But if you've planned ahead, whether it be adding beneficiaries to your bank account or knowing that life insurance policy is there, that money is going to come in very, very soon, that's going to allow you to do what you need to do and grieve and not worry about that financial stress that's going to come along with it.
Right.
Let's just say, man, we got somebody that's minimal annual salary. Let's take $25,000, right? So if I were coming into you to consume from you and just out of your years of experience, is there something you could do to help me to be able to take life insurance and make it a priority even in the midst of my struggle in life?
I mean, I think so. I think you one, you look at, what decks you currently have. Maybe you're not getting it for a replacement of income. So that's saying you just look at everybody's budget differently. Maybe in your situation, it's best to have that because you maybe get a $50,000 policy or just a $100,000 policy that maybe helps bury you and go through the funeral process. I mean, that's still a burden a lot of people don't think about. Right. Suddenly when it's unexpected is that there is a cost for either a funeral or a cremation or or having the only way you get away out of that, I guess, if you donate your body or something like that. But there could be a cost, and that can be an extra burden during that time for your family. So even if you got a $25,000 policy, a 50 or 100, you could probably get something pretty inexpensive. So it really depends. What are you willing to put toward that budget, and what do you want to cover? It's really hard to have a general conversation, but you can find something that works for you and your family.
That you can afford, because at some point in time something's going to matter. And Chris mentioned like the burial, like those costs are not cheap whatsoever. So that's another thing that you leave your family with a burden on if you haven't planned for that. But there are burial policies, things like that, or smaller, $25,000, $15,000 policy, whatever you can afford to have in place to protect your family from that catastrophic.
I just want our viewers and listeners to understand that it doesn't matter where you are financially. You should always talk to somebody just to find out the solutions. Right where you are financially, there has to be a solution. If there's not, then there's not. But if there is one, you should seek it out and utilize it to get things in place to protect your family.
And again, this is all about education again, because and kind of like we talked about in previous shows, I don't remember a lot of times my parents talking about life insurance or really anybody else. You know, it's one of those things that
Most people
nobody
don't want to. We
Yeah,
don't wanna
right.
talk
No one
about
really
death,
wants to.
right?
So what happens as a kid, you don't really ever hear about it, right?
Mhm.
It's only later in life till somebody passes away and now somebody starts talking about it,
Yep.
or you happen to run across it in your education. But it's not something that's readily talked about. So a lot of us don't even think
The-
of it as part of the picture or even understand what it is.
Yeah. The one certain thing in all of our lives, and nobody wants to talk about it.
Death.
Well,
Yeah.
it's, yeah, and it's going back to the whole thing we talked about
Or
before.
plan for it.
Budget. Put a plan together.
Mm-hmm.
You know, go in, talk to somebody, put a plan together. What can I afford in my budget towards life insurance? And
So who should we insure? Who should be insured in our lives, right? Just me, if I'm the only income in the family, should I insure my wife? Should I insure my kids? Like who should be insured?
Well, again, I think it comes back to budget a little bit, but
Mhm.
first, definitely whoever is working. So if only one spouse is working, definitely have that spouse insured. I would still recommend having the other spouse insured
Mhm.
because it's even if something happened to my wife, let's say she was a stay-at-home mom, which my wife was for 10 years. I loved it, and it was great for our kids. But if something happened to her, you know, I'm gonna have to have somebody help fill in that need to go pick up the kids. I can't, you know, I'm still
Exactly.
gonna have to be the breadwinner. So I think insurance on both parents is always great. Insurance on the kids, you know, I think that's more of a budgetary,
Mhm.
you know, answer. You know, how much extra money do I have available to go toward that? And there's some reasons why you would do that. There's some reasons why you wouldn't do that.
Mhm.
There's other ways that you can have insurance on yourself that would give you a reason why not to have it on the kids. It doesn't really help from a cost perspective because they're like at the same cost, no matter if they're 2 or if they're 15, generally. So it's more of, you know, do I have other money available? And I haven't really done a whole lot over my 20 years, but you can.
That's one of the things that enlightened me on with my brief period in the insurance business recently. I looked at was the kids. You know, one of the things that the company I was with talked about was, yeah, it is cheaper for them to get it younger, right? But it also, let's say you get a 20-year, 30-year term policy, that gets them till their age of 30, 40 or something like that at a very minimal cost because you started them out earlier, or until they get to the point where they can afford their own insurance. So most kids in their teens and 20s, they get their first job, they're not
No.
paying life insurance, right? But if something happens to them, who takes that cost, right? You as the parent, that burial cost, whatever assets else they may have to protect. So it is something out there if you can afford it, right? So we're talking about there's probably a totem pole: breadwinner first, right? Protect the incomes, then protect the mom if she's staying at home because yeah, you might incur costs with people, nannies, anything like that, depending on your life status. And then, you know, the kids as well. If you can afford those levels, take advantage of all those levels, right? But start at the top.
just an example, my dad bought a small policy on me as a kid. When I got married, he gave it to me. There was enough money in there for me to then purchase another policy for my family at that point until we bought a term, got married. And so that, you know, that worked out. It started me. It was a great thing for him to give to me as a married
That was
man.
another point that they had talked with us about that I'd never even thought about
Yeah.
there of how you know, getting your kids insurance policy it can be a gift, right? For that they'll be able to take advantage of later.
Right.
It's not looked at the same as us as we may or may not need this
Right.
during our term policy or by the time we die. So who benefits from the insurance policy? When I say that, like I'm talking like beneficiaries. If we pass away, what happens to that money? Who does that go to?
Oh, whoever you're named as beneficiary, which is very important. No, I would really recommend not labeling it to your estate if you can avoid it. I mean, that doesn't help it avoid probate, which could be a whole nother conversation for another day. But, you know, if you don't want to have it pass efficiently and cost effectively, name a beneficiary. So generally you'd want to name your spouse to be the beneficiary because that'd be the person that would be taking care of the finances after you passed away.
What about organizations, right? Can you name an organization as a beneficiary? Like if you're involved with a not-for-profit organization, something like that. Is that something you can do?
Definitely,
Yeah.
I would recommend. We have clients that are very charitable minded, and you know maybe leave a university or a church or a hospital. And that's the nice thing about having a universal life or a whole life policy that you had later on in life. You can now turn that into a gift to a charity and say, okay, I don't need it anymore. My kids don't need it anymore, but I could definitely leave that to a nonprofit that I support and be a great legacy that you could leave for them.
And beneficiaries are something that you can change periodically as your
Yes.
life changes,
Right.
right? You name your
Anytime-
wife as beneficiary, and then you're no longer together, and you feel it's not in the best interest. Like you can change those things as you go on, or as you
Anytime,
get
every
older.
day.
Yeah, your kids are in a financially great situation. They don't necessarily need it. You are somebody that's very charitable, and you want to leave that money to that organization that you've supported all these years. You can do that, right?
Right.
Yeah. So running out of time here, just a couple other things I want to touch on real quick, different types of insurances. So we talked about there's like a death and burial insurance. That's something you can get even later in life. I believe the company that was with here recently, I think even up to the age of 90, you could purchase a burial.
Very,
plan, right?
It can be very expensive for what the death benefit is, but it's better than nothing, possibly.
Yeah, because it's going to cover that burial expense and the casket or however you need. That's going to be very expensive as well. Accidental death and dismemberment, those are things you can purchase as well, which isn't just if you pass away, but if you're involved in like an accident, or maybe you don't pass away, but you lose an arm or something that's debilitating that makes it so you cannot work, it pays out a percentage. So another type of insurance to look at. And then short-term and long-term disability as well. If you're off work for a short period of time due to a disability or an extended period of time, those are insurance you can purchase. A lot of times those are things that you can get through your employer as well, a very cheap cost. But do you gentlemen, is that something that you work with as well, those type of insurances?
Yep. Yeah, disability, accidental death, not so much. A lot of times that's just done through credit cards or banks handle a lot of those a lot of times. But there are some markets out there. But disability, definitely. The death and burial policies, I kind of fit that into term or something like that. But we can definitely point you in the right direction.
Absolutely. Great. Well, that brings us to the end of today's show. Life insurance is not always the most exciting thing to talk about, but hopefully we provide some great tips for you. And most importantly, just get it out there that we're all going to pass away at some point in time. Have those conversations and plan for it, right? It's going to be a huge deal if you pass away and you have not planned for that when it comes to your financial situation with your family. Right. So have those conversations and, put yourself in a position to take care of your family when you're gone. So I'm Ryan Leopard. This is Our Neutral Voices. Join us again next week at 8:30 a.m. next Wednesday. Until then, peace.
Happy trails.
Happy trails.